Okay, welcome to the Swing Trading with Cycles channel. This is where we time the markets without predicting the markets. Trend analysis. Find those reversals. Get in early in the trend. We are going to review Dixie today, the US Dollar Index. We'll also look at some bonds, including corporate bonds, if we get a chance. It's October 11th, so it's Tuesday night. So we had a move yesterday. I always say Tuesday is a good time to learn. Are we going to get a rejection of the move that happened on Monday? Are we going to get follow through of the move? Or is it just going to consolidate, which is usually an inside day? And I will say, it doesn't have to be an inside day for it to be consolidation. Sometimes you make a slight higher high or a slight lower low and you don't really go anywhere. That's also consolidation. It doesn't have to be an inside day. That's an important thing. As you get more experienced, you don't have to be like so literal. And so now, daily cycle for the Dixie, and I'll assume that you've already reviewed Cycles 101. That's in the description. There's a link in the description, as always. So take a look at that. Make sure that you're like caught up to speed. There's also some written content if you prefer that. So we have our high on day 11, right? And then we come down. We made this swing low. So this was day 11, day 12, 13, 14, 15. So we have a swing low on day 15. And how do we know it's a swing low? Well, this is the candle that marks the low, and the high from this candle is at 111.886. So once we crossed above that, that gave us a swing low. So this candle is technically the one that created the swing low. And then we've had 3 days of follow through. Now this is important on the daily chart. At one point, this was So this is the candle from today, Tuesday. This is what will be your Wednesday candle. Dixie starts to trade at 8 p.m. This is being recorded at around 8:30, so we've been trading for about half an hour now. So again, this is your what will be your Wednesday candle, day 21. This was your Tuesday. This was your Tuesday candle. At one point, this was a red candle. I know that because I actually took a glance at it intraday, and I sent a chart over Twitter actually, where I posted, so far it's a bearish outside day. Now, a bearish outside day is always red. That's how it works by definition. But this candle is obviously not red. This is a green hammer-ish like candle. And that's because this is a outside candle that was bearish that turned bullish. That's a really important concept to understand, right? A candle could go outside. Again, an outside candle just means, like in this case, and just to be crystal clear, we broke above the high from the previous candle and we broke above the low. You can see that very clearly. Hopefully you didn't need me to draw those lines to see that. But you can see we poked below the low. Well, right? And then we poked above it as well. But then we closed green, right? At one point, we actually were red because we made the high first and then we came down here and made a low and then we rebounded. This is just an indication of very choppy action, right? Like think about that. A candle makes a new high, then it fails out of the other side, goes red, and then it goes green again, goes all the way back closer to the top of the range. That's just extreme chop, and that's not surprising. We have a lot of data to chew through this week. So Wednesday morning, October 12th, 8:30 Eastern, we have the PPI print, so the producer price index. And then Thursday morning at 8:30 Eastern again, we have the CPI. We tend to get the big moves off of CPI, but as I said, the market is really clamoring for any data point it can get. And so it's going to be paying very close attention to the PPI report as well tomorrow. So this is your daily chart. I'll actually zoom in. Let's look at like a 15-minute chart. I don't often do this. I'll take off the moving average. But in this case, I just want you to see what happened throughout the day. I think that is very useful, right? So, and remember, this is your line. I hope you're understanding this is some of the biggest alpha on this channel. This is multiple time frame analysis. It's one of the ways we're able to time the market, again, without predicting it. If we can look at multiple time frames, one way to think about it is when you look at the lower time frames, it's almost like a time machine to the future because it tells you what might be happening on the higher time frames. So these lines are those same lines that we drew to show the range for Monday. And we know we went outside the range and we went below the range. So this is your 15-minute candle. Let's go to the start of the day, like approximately. So let's call this, something like this, right? So this is Tuesday, 7 a.m., So that's earlier today. So We had this rally up here, and then what is this? It's a swing high. This is a 15-minute chart, so I don't usually zoom down to this kind of level. This is more for like day trading if you're like really into it. But if you're really in it, like, minute to minute. But again, all the principles are the same, folks. That's super important. Swing highs, swing lows, it's all the same stuff on different time frames. So once we went below the low of this candle here, we made a swing high. So this candle is the low is at 113.192, right? And so we created a swing high. This is your lower, and again, like trend analysis. I don't want to belabor the point here, but we went like this, and we made a lower low, another lower low, another lower high, another lower low, and then this is like, oh, wait a second, this is a lower high, this is a higher low, and then we make this move up, and then we make this higher low, and now we're kind of bull flagging, you could say, right? But what's most important though is, so again, we made this swing low with this swing high here, but just notice how we poked below the range. That's when it became a bearish outside candle, when we went below this line. And what does this look like to you? Again, this is a false breakdown. That's what I keep explaining, and I hope it's starting to kind of gel. An outside candle is just a false breakdown or false breakout, right? Because it means we went below some previous range, and then we came back into the range. In this case, we went all the way back up to the top of the range, and now we've come back a little bit. So this is like extreme chop, like this big move down, big move up, all to kind of end up really doing nothing. So that was a zoom down to the 15-minute candle again to illustrate that the fractals, the way price action works on multiple time frames. We'll move on to the weekly chart, and last week, same kind of idea, right, as what happened today, where we had a candle that had made a lower low, but then it went green by the end of the week, bullish hammer, and we knew we were set up for potentially a weekly swing low, and that's exactly what we got once we went above that low. So far we have a weekly swing low. We obviously have 3 trading days left, Wednesday, Thursday, Friday, and we know they're going to be stacked with volatility with all that data coming out. So at this point, this swing low means nothing, right? It's a signal that you don't really pay attention to because there's so much left to be kind of unfinished. But it's important to know how we're set up right now, right? Like on its face, this is pretty bullish. If you didn't know about the huge catalyst coming, not to say this is necessarily going to go lower, but you just know it's going to be volatile. So that puts us at month 19. We so far have a top on week 19. We so far have a top on week 17. But with a good push, we'll make a new high. At the same time, this is incredibly late, and I'll put the indicators back on. This is your 10-week moving average. Notice we didn't even touch it on this decline, and we're so late in the weekly cycle. I mean, we're at week 19. You can see the last weekly cycle bottomed on week 20. You could make an argument that maybe this was some kind of really shallow weekly cycle low, or maybe this was your weekly cycle low. Either way, this is a real indication to you that there are a lot of people clamoring for dollars, and this thing could go much higher before it really pulls back. And that's what it takes us to the monthly chart, and we think about the 3-year cycle. So 3-year cycle, easy math, that's 36 months. This is month 21. We so far have our month high on month 2020, which was September. Notice I've drawn these lines. I hope this is seeming familiar to you. Again, this is just the same principle on the different time frames. So this candle, this is the range of this candle, these 2 lines, right? And so right now, October, again, this is your September monthly candle. The October candle is just inside, right? It's just until we get above, the high from last month, which is 114.778, we're really just an inside candle. And again, we know because of the catalysts that are coming, this thing could bounce around in here and just kind of do almost nothing. So you want to be aware of that. We can't get really bearish until we get to this level and we fail below it and maybe can't get back above it. And it's hard to really get bullish until we're back to clean air. My base case is this thing probably runs to 120 before the 3-year cycle high, right? This would be your 3-year cycle high somewhere around January 2024. So you could easily see a world where we continue to move higher. So again, this is your month 20. Maybe we have our top on month 26, 25. That would put your top around March 2023, which I think will probably coincide with the 3-year cycle low for most assets. It makes sense that those things would kind of correlate. So that's the picture for the dollar. Probably gonna have some kind of weekly cycle pullback. I guess that's the other thing I would say. All these up days here are still below this swing high, and so this could actually be a rising bearish wedge. I mean, this is just a lower high at this point. If we get a big decline in a swing high that holds, this will become a lower high of this. So that's important to know about. But all that said, short-term pullback, because again, we're really late in the weekly cycle, so you would think we're going to get a weekly cycle decline that's going to go below the 10-week moving average, but you want to look for that as a buying opportunity. It doesn't mean it will be, but it may be, because we would expect the monthly cycle to keep running. The 3-year cycle to keep running. You can see the last 3-year cycle, which was pretty bearish actually, topped out on month 25. So I have no reason to think that this one can't go another 25 months, maybe even a little bit more. So now we'll look at yields really quickly. We'll look at the 10-year yield. This is the thing that's most closely watched in terms of its correlation with other things like mortgage rates, for instance. So we had this potential swing high. It was a swing high at one point. This is your weekly chart. We did not make a new, and then the following week, and then we kind of reversed and went green. It didn't go bullish outside because we needed to go above this high, but we're trying to complete that pattern this week. I talked about that in the last video, and as always, link in the description to the previous video that talks about the dollar index. And it'll probably be one of the options that comes at the end of the video for your kind of convenience. But this is the concept of like a compound candle. So we didn't become a bullish outside candle on this candle, but if you combine these two candles, that becomes a bullish outside candle of this. It happens sometimes. It's something to be aware of. Sometimes we just kind of run out of time. It's a great concept by the strat. You can see we're perched way above the 10-week moving average. So at some point we're going to get a pullback similar to the dollar. It could be the pullback that everyone thinks, oh, okay, rates are finally topped. And it's like, when you say something is topped, you have to be very clear about what your time frame is. Are you saying it topped for the 3-year cycle? Because that's a big top. That means we're going to roll over for months. Or has it topped out for the weekly cycle? We get a little 3, maybe even 4-week decline, and then we resume back to making higher highs and higher lows. You have to be specific. That's what we're going to be watching for. So this is week 10. I've drawn this outline. If we imagine we have a 20-week cycle, that would take us to the late December period. Doesn't tell us when the high is going to be, but that would tell you at 10 weeks, like we're probably we're probably midway through the cycle. Assuming it's a 20-week cycle, there's no reason to think it certainly will be. We're just going off of like real ballpark. This was an 18-week cycle. This was much longer at 35. This was 29. So we have to be nimble and watch the price action. But this gives us a little bit of a scenario to work off of. If you think about the monthly chart, again, going back to that idea of a 3-year cycle, this thing has been rallying for 29 months, right? Like if it's going to be for 30 months, if it's going to be a 3-year cycle, right? Then this is going to be an extremely left translated 3-year cycle. Like imagine a 3-year cycle that rises for 33 months, then falls for 3 months to a 36-month low, and then keeps moving higher. So that's important. So that tells you simultaneously we could get a major top here because we've been rallying for 30 months, right? But it could also tells you maybe the decline is actually relatively shallow for a long-term cycle decline, and that actually means rates have more room to the upside for longer. Maybe it's even just a protracted consolidation that doesn't kind of fall off a cliff. So that's going to be important. The other one we'll look at is TYX, which is the 30-year yield. This is a little bit more pure. And in this case, we actually have already made a new weekly high, whereas the 10-year yield hasn't yet. And it's the same kind of idea. This is month 10. If you imagine we have a 20-ish week cycle, that puts you at late December. And same idea, same exact idea. We've been rallying for 30 months here. At some point, we're going to see a pullback. I think this range is going to be important if you look at these two candles combined. Like getting below this September candle, the low at 3.292, which is a long way down from here. We're almost at 4%. Is going to be important. It tells me that at some point, price is going to fall below there. We're going to make a monthly swing high. We'll have to see if we get like a sort of waterfall decline from there. But I suspect that level is going to be tested at some point. And we'll know that by spotting a daily swing high, which turns into a weekly swing high, etc. And so finally, as I alluded to, let's look at corporate bonds really quickly. They tend to be the canary in the coal mine. So we'll look at the monthly chart. I mean, this is your COVID low. We're now well below the COVID low. I pointed this out in the last video. That's not a good sign. And most importantly, take a look at this. This is really damning. We back tested the COVID low from below and we failed. How do I know that? Because of this upper wick. This upper wick tells us price traded up here and then couldn't make it, right? If we zoom down to like the daily, right, that's it. So again, multiple time frame analysis. This is your daily chart. We had this little feeble rally topped out here. And what is this? That's right, folks. It's a swing high. That's what created your bearish sort of monthly candle that has that upper wick. And so now we're cascading lower. We've made this lower low here. At some point, we'll get some kind of retracement for a lower high and then on to making another lower low. So that's LQD. That's the investment grade corporate bonds. So theoretically, the quote unquote safer ones, the ones that you would think are less likely to default. This is your weekly chart, just kind of falling off a cliff. And TLT is actually tracks government bonds. And I'll look at the weekly chart. So this last weekly cycle was really long at 31 weeks, and it had a top on week 7. And then we had another top on week 7, and now we're on week 17. Now, what a lot of cycles analysts on Twitter will call out is that the first daily cycle of an intermediate cycle cannot fail, quote unquote, cannot fail. I say that doesn't make sense to me because if something is incredibly bearish, then of course the first daily cycle can fail. There's absolutely no reason it can't, right? And this goes back to that broader point. Price action is going to do what price action is going to do. It's our job to analyze that price action, and we use cycles to categorize it, not to try to, like, the price action doesn't explain the cycles. It's the other way around, folks. Follow the price action, respect it, understand it, and then you apply the cycle count. All that to say, I would say the first daily cycle can fail, and it did fail. And this is a weekly cycle that topped out on week 7, which is a hell of a coincidence because this one topped out on week 7 as well. Again, I think that is just a coincidence. Certainly there was a world where maybe the rally would make it back to the 200-week moving average, this yellow line here. Obviously hasn't. At the same time, I mean, this kind of precipitous decline at some point is going to lead to a vicious rally. Doesn't mean we're going to recapture all these highs, but at some point there's going to be a vicious bounce. And so we want to be aware of that. At week 17, tells us we could have a lot more downsides because these weekly cycles tend to be around 30 weeks. So that is important to understand. And the monthly chart, oh my God, look at that thing. So we are on month 19. The top was on month 9. So that said, we're getting later in this kind of longer term cycle, right? So this previous long-term cycle was 15 months. The one before that was 13. You could certainly quibble and say this whole thing is 28, whatever. This was 20, this was 21, this is 18. So we could also, just to be clear, just because a long-term cycle comes to an end doesn't mean it's bullish. You can start another long-term cycle that itself is not bullish and actually has a sort of early top. So we have to be careful of that. This 110 level area looks like it's going to be pivotal. Like you could see a world where we rally back to that, then fail lower. But this is all painting a very bleak picture. That said, a big part of the game is understanding what not to invest in. Not losing money is just as important as making money. And right now, that's what we're really talking about on this channel because most assets are moving into a 3-year cycle low. That is, of course, unless you're inclined to short, unless you're aggressive. Otherwise, we're in major downtrends across most things, and it's wise to just stay away. The dollar being the exception to Dixie, obviously, that it's moving higher. At some point, it's going to fall off a cliff, and that'll be the time to again, if you're aggressive, potentially short UUP, which is an ETF that tracks the Dixie, or it'll make a lot of other risk assets kind of run. So you might you'll find some upside with those. So that's the lay of the land for the Dixie, and also just again covered the 10-year yield, the 30-year yield, TLT, and we also looked at corporate bonds in ticker symbol LQD. Thanks for watching, and if you haven't already, please like the video if you found this content useful. Subscribe if you want those timely updates. I would recommend hitting the notification button as well. Thank you, and see you guys later.